Generally, if you're buying the assets of a business, you'll want to understand the tax characteristics of those assets. For example, will each asset that you'll buy give you a write-off for tax purposes? And if so, how will you claim the write-off over time? If you're buying the assets of a business, you may be able over time to write off the assets for tax purposes based on what you paid for them. On the other hand, if you're buying a business by purchasing the shares of the company that owns the business, as opposed to directly buying the assets, you'll be inheriting the existing tax cost of the assets within the business, and you may only be able to write off the assets from their current tax costs within the company. Now, there are planning techniques you may be able to use to bump up the tax cost of certain company assets, on the basis that the price you paid for the company's shares reflected the accrued gains within the company's assets. This means the company will pay less tax when it sells the asset. You should also understand that when you buy the shares of a company, you may also inherit its recorded and unrecorded liabilities, including tax. So obviously, it's essential that you know exactly what these liabilities are. At Crowe Soberman, we can perform tax due diligence on the company. This might include reading the company's past tax returns and financial statements, as well as speaking with the company's past owners and advisors. This will help you understand the tax liabilities you may be inheriting if you buy the company, and it may be an important factor in your negotiations.